just start things off with the things that struck you in either JPMorgan or Wells that were most noteworthy. You probably realize there'd be a big addition to the reserves.
Yes. When you look at this, we have to change our perspectives. It used to be returns and revenue growth. All that's basically where it was when we left it off. We now are focused completely on credit and how much capital do we have to be able to pay for the credit costs. If you look at the earnings that JPMorgan just released at 78 cents, that compares to what they're paying in dividends of 90 cents. So they basically earned their dividend, which is the first threshold. If we looked at their total credit costs for the year, where they could be able to do that, we have a cushion of about $30 billion. They put $8 billion away this quarter, so like pretty much in line with what we would expect to be able to defend what you're looking at in the dividend. And you look at their tangible book value is relatively flat. So in the quadrants that we're looking at, liquidity, deposits are strong, up 23%. So we're not seeing liquidity crunch on the banks. Capital is defendable, and that leads into pretty stable dividends and tangible book value so far.
So far, so good, is what you're saying then. So how long can it stay that way? The banks are in better shape than they've been in years past, I guess. So how long? We have time?
So that's actually the question that is what we put in our note yesterday. We put it out there, was how many years can we actually burn through this? If we're earning where we're at today, we have several years to kind of go through that process. If it continues to go and the economic disruption builds from here, then these credit numbers will go higher. So what we think is, if we can get back to work sometime before summer, then we'll actually start to see what we're running on these run rates, go through another quarter in the second quarter, have a little bit more in the third quarter. But what we've been preparing for the last decade is have enough liquidity and capital to be able for these banks to do what they just talked about. Lean into this, help their customers, focus on their employees, and being part of the solution, not a part of the problem. And that's really what the bankers are working hard to do, be on that front line on this economic distress. They can't help on the medical side, but they can help on the economic distress because of the strength that's been built over the last decade.
So what would you ask? Would you have questions for the CFO of Wells Fargo? What would you want to know about what he's thinking about, what they're planning for the future?
The key thing that you need to know about is, given the accounting methodology that we just adopted back in January 1st, and it's just unimaginable that you put this new accounting in, we knew it's going to create more volatility in credit costs. But how much of this credit cost is actually getting pulled forward because of this accounting? How much will we see as we kind of roll into the second quarter and third quarter? So understanding this new accounting methodology that all these big banks are having to deal with, and the impact of accelerating some of this is going to be a key question that we're going to want to get an answer to on these earnings calls that are coming up here shortly.